Hello everyone, consider this is a stage and you are in the audience. Welcome to the class. An investment is not about who owns it, it is about what supports it. So let me start with a simple story. Ramesh is a middle class salaried employee. He invested his savings in home loan securities issued by HDFC Limited because they were considered safe and stable. One morning, Ramesh reads the news. HDFC Limited has merged into HDFC Bank. He immediately becomes worried. The company I trusted doesn't exist anymore? Will I still get my money? Are my investments still safe? This confusion faced by Ramesh is exactly what our case study is about. In this video, we will explain this topic in very simple language. What mortgage-backed PTCs are, what changed after the merger, why ratings are still stable, and what investors should understand from this. So let us begin by understanding the foundation of this case, the home loans and PTCs. In fixed income markets, stability is not created by headlines but by cash flows. This case focuses on mortgage-backed securities originally issued by HDFC Limited and how their risk and credit ratings are evaluated after the merger of HDFC Limited into HDFC Bank. The key idea of this case is not the merger itself, but how such a major corporate restructuring affects already issued debt instruments. Before the merger, HDFC Limited was a housing finance company that issued large volumes of house loans across India. These loans were later securitized into mortgage-backed pass-through certificates or PTCs. After the merger in 2023, HDFC Limited ceased to exist as a separate entity, but the loan pools created earlier continued to exist. These are known as legacy HDFC Limited pools. This raised an important concern for investors and rating agencies. Does a change in the issuer structure impact the safety, risk, or credit quality of existing mortgage-backed PTCs? This case helps us understand how securitization works in practice and how rating agencies evaluate risk beyond company names.
Now let us understand what are mortgage-based PTCs and why HDFC Limited used them. Mortgage-backed pass-through certificates are structured financial instruments created through the process of securitization. Now, what is securitization? Remember the subprime crisis and how the banks use their non-performing assets tradable for the traders. To understand the relevance of PTCs, let us first understand why HDFC relied on them. HDFC Limited was primarily a housing finance company that provided long-term home loans, typically with a maturity of 15 to 25 years. While these loans generated stable and predictable cash flows through EMIs, they are also locked in capital for extended periods, creating liquidity constraints for the lenders like banks, as demands for the new house loans continue to grow. To address the challenge, HDFC Limited used securitization. Under this process, pool of existing home loans are transferred into special purpose vehicle SPVs or trusts, which then issued the pass-through certificates that are open for the investors. This transfer legally separated the loan pool from the HDFC Limited balance sheet, with the trust becoming the owner of their own underlying cash flows. That means now the investor can invest into these SPVs and get the future cash flows, and the bank is free from them. PTCs represent an investor's proportional claim on EMIs paid by the borrowers after the collection and the deduction of the serving fees. Cash flows are passed directly to the investors, making returns dependent on the borrower's repayment rather than HDFC Limited on their own financial performance. These instruments are termed mortgage-backed because the underlying loans are secured by the residential properties, significantly reducing the credit risk. HDFC Limited issues mortgage-backed PTCs for multiple strategic reasons. Securitization enables capital release by converting long-term receivables into the upfront cash that can be used to give the further loans. Improved liquidity, reduced balance sheet risk, and supported further loan origination without excessive leverage. Additionally, it helps manage the interest rate, asset concentration risk. These PTCs were generally assigned high credit rating due to the diversification of loan pools. The strong borrowers profiles, low historical default credits, and the credit enhancement mechanism. Even after the merger of the HDFC Limited with HDFC Bank, the structure and the cash flows of these PTCs remain unchanged, which explains why rating agencies continue to view them as stable and low risk instruments.
The merger between HDFC Limited and HDFC Bank and its impact on PTCs. So the next important part of the case is merger between HDFC Limited and HDFC Bank. In 2023, HDFC Limited merged with HDFC Bank to form a single entity, stronger financial institution. And after this merger, HDFC Limited stopped operating as a separate company, and all its loan activities were taken over by HDFC Bank. However, this merger did not create any major problem for mortgage backed pass through the certificates, PTCs that were issued by before the merger. The home loans that were securitized earlier had already been legally transferred to special trust. Because of this, the merger did not change structure or ownership of these PTCs. Borrowers continue to repay their home loans as the same as before, with no change in the interest rate, loan tenure, or the EMI amount. The houses given as collateral also remained the same. The main change after the merger was related to servicing, the responsibility of collecting EMIs, keeping borrowers' record, tracking defaults, and sending money to securitization trust was shifted from HDFC Limited to HDFC Bank. Servicing is very important mortgage backed securitized because timely EMI collection ensures regular payments to investors. From a risk point of view, this change was actually beneficial. HDFC Bank follows stricter regulations, has better systems, and strong financial support. Because of the EMI collection become more reliable and efficient. Overall, the manager did not affect investor cash flow. In fact, it is improved operational stability. Therefore, ratings agency considered the impact of the merger on PTCs to be credit neutral or slightly positive.
Now we come to the most important part of the case, credit rating and rating rationale. Credit rating agency mainly judge mortgage-backed PTC based on the quality of underlying home loans, not on the change in the company structure. Their focus is whether the security can generate regular and timely cash flow or not. After the merger of HDFC Limited with HDFC Bank, agency reviewed that the loan pools and found that borrower repayment remained stable and delinquencies did not increase. They also observed that the credit enhancement remained strong and loan servicing improved under HDFC Bank due to the better system and regulation. Because of this, the rating were mostly reaffirmed, not downgraded. Some risks like prepayment risk still exist, but they were already considered earlier and did not change after the merger. Overall, the case showed that strong asset quality and stable cash flow keep securitized instruments safe even during the